Hey, everybody, welcome to another episode of Raising the Flipping Bar. I'm your host, Derek Marlin, and I'm excited to have everybody back because we're starting to get back into the rhythm of some episodes that I want to have on a consistent basis because I want you guys to be able to come back and listen and compare what's going on. And so right now we're going to be doing a market update. We are recording this in October of 2024. So we're going to do a little look back. We're going to do third quarter of 2024. And just keep in mind, our data is always about 30 days behind. We try to keep current. We'll talk a little bit about how we do that later in the episode, but we're always doing about a 1 month look back. So we're going to also talk about what we're doing today, not only from a data perspective, but what we're actually doing in our company. Because again, we always want to be definitely doers and not just teachers, even though I kind of love both. So we're going to talk about the projects that we just got done doing. We're going to talk about what we're just getting into. So let's jump into today's episode. Welcome to Raising the Flipping Bar, the go-to podcast for aspiring and seasoned real estate investors. I'm your host, Derek Marlin, and I'm the CEO of Elevation. We're a real estate investment company based right here in Denver, Colorado. We'll dive into smart investment strategies, market insights, and essential tips for scaling your real estate ventures. Whether you're making your first investment or your 100th investment, this podcast is your blueprint for success in the ever-evolving world of real estate investing. Get ready to elevate your real estate game and begin your journey with me. So in a lot of our episodes, we do try to set the stage and try to hopefully weave that storytelling aspect with the hard facts of exactly what we're doing. So unfortunately, the story starts with us getting our asses handed to us. And that's in our last two fix and flips that we finished and sold in the very beginning of the third quarter. And the tough thing is that these were actually two of my most favorite projects from a design perspective. They were over $1 million. They were between 1.15 and $1.2 million. And one was in Sloan's Lake, and then another one was in West Wash Park. And one was a mid-mod, so it was super cool looking. And then the other one was this beautiful historic home. Luckily, it wasn't in the historic district, but it was a historic home. And so it just had great bones and great character. The problem is these two properties, we lost over $100,000. So again, I am really, really a big proponent. Those of you that have listened for a while will know we have to talk about the good, but we also have to talk about the bad. So for us losing over 100K, obviously it absolutely sucks. It did also kind of hurt our track record a little bit. We're coming up on our 90th deal, and four of them we've lost money, and sadly, two of those have happened in the last 6 months. So you got to be kind of very aware of market conditions and what's going on, which is why we're doing this type of market update. The other thing is definitely stay till the end of this episode. We're going to dive into what we're talking about and what we're doing for fourth quarter this year and really what we're going to focus on for 2025. So really the moral of the story is when, even though we thought both of these deals, we underwrote them or analyzed them as home runs and thought we had as much margin of safety as humanly possible, when you mix the city and county of Denver and the ridiculous permitting process, when you talk about significantly large six-figure rehab budgets, when you talk about a slowing market and a kind of a price point that is very sensitive, meaning $1 million to $2 million. Below that, you're closer to median home price. Above $2 million, you really have people that have that cash and that discretion to kind of buy whatever they want. And 9 times out of 10, even though you might have a fixed up property, they might actually do something that is their personal taste anyways. But that $1 to $2 million price point, we kind of, again, just got our asses handed to us. And it was a big learning curve. So it's all about, you think you're going to hit a home run, but you still might strike out. So as we look at third quarter data for 2024, again, we're always looking back roughly 1 month. And so definitely check the show notes. We've got all of our sources. There's 3 or 4 different data sources that we really like to look at. One is the Denver Metro Association of Realtors, or DMAR, as they say for short. We're also going to be looking at data from Redfin. And then we're also going to be looking at data that gets pulled and sent to us from First American Title. Shout out to Megan Aller, a fantastic sales rep over there. She puts on these weekly seminars, and those are super important to us because you can kind of see what's going on in a much shorter snapshot, piece that all together, and then get ready for what you're going to see in the rest of the month, ahead. So as of right now, we're going to go right down the line. We'll put in some, again, graphics for those of you watching online. But our median home price in Metro Denver is $576,000. That is down %. I'd really like to use this metric rather than average because in Denver, again, think back to your kind of 101 statistics classes. You've got, $200,000 condo and, the $25 million Russell Wilson sale. Rest in peace, Russ. Glad you're doing great for the Steelers. Different episode. Sorry, squirrel. But that obviously screws up your average. Median is, that bell curve distribution, like where homes selling for in the middle of that overall curve. So 576 grand is our median home price. The number of closed transactions is just over 3,000. So it is 3,092 transactions. That's, again, every price point, every type of property in Metro Denver that sold in September. That is down 19%. And again, this is looking at the month prior. Here's one that I really, really want you to focus in on. And for us, this is probably one of our number one things that we look at is what is the active inventory right now? So as of the end of September, there were just over 11,100 properties for sale at every single price point. That is an increase in the available inventory of 3.65%. That is a significant jump from how many homes were for sale in second quarter. And again, it's kind of all about, I guess the best way to say this is looking at statistics through a reasonable and a logical lens, because in second quarter, there were 5,500 actives. So it was kind of this perfect storm of, obviously it's a hotter selling season in the spring and the early summer. So you're going to sell through houses faster. They also didn't have as many hit the market. Right now, we've got stuff that's hitting the market and it's not selling as quick. And then when you have more stuff hit the market, your inventory levels rise. So right now we have 3.6 months of inventory in the market. That is also up 21%. So again, these are fairly significant increases you need to be aware of. And what does that month of inventory mean? And months of inventory is essentially, it would take 3.6 months if no new properties came on the market to sell everything. Obviously, that's kind of a weird statistic in that it never happens where, nothing comes on the market. But again, it's like how fast will you burn through the inventory? That's also a fairly decent increase from second quarter. And it was actually, second quarter was up 12%. So overall, another statistic we really like to look at is days on market. And again, that is how long is the average home once it's listed before it goes under contract. And that doesn't mean that it's closed, but that's a good indicator of once you get in contract, you have a typically fairly high chance of closing. And we'll talk about those data points here in just a second. The median, again, median days on market is 25 days on market. That is up 19%. But again, that's one where we got to kind of frame why we're saying this statistic. It's always going to be longer days on market in the late fall. It definitely increases throughout the winter. And then it starts to go down from February through May, which is kind of your peak selling season. So we got to factor in seasonality, but we still have to look at those trends that overall there's more properties hitting the market. They're staying on the market a little bit longer, and we definitely continue to have more active listings. Kind of give you some crazy big picture historical perspective, some of the data that I've seen, and I'm not going to get this number exactly right, but during the housing crash in Metro Denver, 2008, 2009, we would peak out over 30,000 properties on the market. So if you were active at that time, or even if you were just driving around, you kind of felt like, holy crap, I see for sale signs everywhere. And that was actually not the full totality of how much stuff was on the market, because there were short sales, there were places that didn't have signs in the yard, but that was a ton. So we're still 1/3 of that. And we're leaning towards the data that we saw in 2018 and 2019, which was a much more balanced market. The other data points that I want to talk about are Redfin and then again, First American Title. So Redfin has some cool, interesting data points that I want you guys to focus in on. And it's called the hot housing market. And they score it from 1 to 100. And right now, Denver currently sits at a 67 out of 100. For perspective, last quarter, Denver was an 87 out of 100. So again, kind of what we just talked about earlier in the episode, it's going to go up at certain points of the year. It's going to kind of fade down during certain points of the year. But in general, we still have dropped. And then what they say that essentially means is that we went from a truly hot market to a somewhat competitive market. So, I mean, I'm sure some of you guys are listening like, well, what the hell does that mean? Here's some more hard stats. 19% of homes are selling above asking price. That is down 6% from year to year. And that's a stat I really want to look at is like, what was going on a year ago at this moment in time or this month in time, and what's going on right now. So that number is definitely trailing down, but it's not falling off a cliff. This is kind of a bigger one. 44% of homes have at least one price drop. That is only down 1% year to year. So on average, we're kind of keeping consistent 1 year to the next of the number of homes that have price drops. And again, this is my just kind of random anecdotal evidence, but I still think that there is data that shows that 50% of real estate agents actually don't do any transactions within 1 year. And then of the other 50%, there's a big chunk of those folks, between 60 and 70% of those folks do less than 4 transactions a year. So a lot of times their measure of analysis is based on not doing a lot of deals and not doing them more recently. So if you've got somebody who has that memory of, oh, well, if I just put a house on the market, it's going to fly off the shelf. I'm going to get multiple offers. Again, my least favorite term, I'm just going to throw it out there and see what happens, or test the market. That's code for, if you hear that and you have an agent that's doing that, you need to hire a different agent. But in general, it's all about just kind of throwing things out there and trying to see if you can get a high price. And if not, we can cut the price. I understand that to some degree, because if people think they're going to make that happen, I guess it's almost like a car lot. If you think of it this way, a car lot can price a car at a higher price. And as long as they have the ability to hold that in their inventory for a little while, or you as a seller have the ability to not have to sell your house, okay, I kind of get it. But that's really what's leading that statistic of houses are coming on the market a little overpriced, almost half the time. So again, 44% are having a price drop. Then we look at how many showings have to happen before a house goes under contract for the first time. So right now we need 15 showings in Metro Denver before a house goes under contract. And on average, again, this is Redfin data, so it's probably pulling from a little bit different data set. Their median days on market is 31. So you're somewhere between 26 and 31 days. So roughly you're needing 1 month to go under contract. 15 showings are happening on average before you go under contract. 19% of the time it's selling for above asking. 44% of the time it is selling for, there's at least one price drop, or it's selling below asking. And so this is another kind of cool point that I looked at that Redfin has, and I really like that they post this information. They have the top in-migration for Denver, which means where are people coming from and moving to Denver. And they also have the top out migration, meaning when people leave Denver, where do they go? So the one I kind of want to focus on is where are people coming from. Number 1 market is Houston. Number 2 market is LA. Number 3 market is San Francisco. And then it was kind of interesting. Obviously, it is a different market, but the number 4 market where people are leaving and coming to Denver is from Pueblo, which is kind of interesting. Actually, one of our Rockstar agents, shout out to John, he moved his family up from Pueblo and came to Metro Denver. So it's something that it's kind of interesting that people are kind of leaving smaller cities in Colorado and relocating to the quote unquote big city. But I think it's very telling that you've got folks from Texas and folks from California that are still moving to Denver. So if you lean more on the traditional side, those might be good places to market. Again, this data is all seasonally adjusted. It's normal for things in the fall to be a little bit slower than it is during the summer, but these are still things we really, really need to watch for. And to me, this really continues to show that we are shifting to a balanced market, which means where does the advantage lie? There's fairly good advantages, and maybe what you would call it disadvantages, on both the behalf of the sellers and the buyers. So again, houses aren't flying off the shelf, but they're also not sitting for 6 months if they're priced appropriately. They used to say that a balanced market was 6 months of inventory. I think that's kind of an old data point. To me, what we're seeing real time is between 3 and 4 months of inventory would truly be kind of that equal balance of power, if you will, between seller and buyer. So definitely some things to consider. Dealing with hard money lenders is the biggest headache real estate investors have. I thought that's just how hard money had to be until I met Backflip. Backflip is changing the lending game by actually making loans stress-free. And I know this firsthand because I personally use them for my own deals. Let me tell you, their free app makes real estate investing effortless. With just a few taps, I can apply for loans tailored exactly to my needs, whether it's low interest rates, high leverage, or even deferred payments. The best part, I can secure financing in less than 2 weeks, making it easier to scale my business and close more profitable deals. But it doesn't stop there. Backflip instantly provides all the data I need to estimate profits, including a curated list of high-quality comps, saving me hours of work. Unlike other lenders who disappear after funding, Backflip is a true partner for elevation. Their team is always just a call away and ready to answer any questions and offer support. With Backflip, you get the data and the cash you need to jump on good investments quickly and with confidence. Click the link in the show notes to download the free app. Now let's get back to the show. I also, again, like I said, I want to give a shout out to Megan Aller at First American Title. Her data, she's essentially a statistician, in my opinion. So I'm going to read specifically. So those of you watching online, I'm going to read this quote because I don't want to mess it up because I think it's really, really important. This is only a week old. So by the time this episode comes out, maybe 2 weeks max. And so her summary for late third quarter is People ask her, well, how's the market going? She says, central Denver has cooled significantly, with areas like Lodo, Cherry Creek, Sloan's Lake, and the Highlands showing 5 to 8 months of inventory. Meanwhile, suburban areas to the north, west, and southwest of Metro Denver are experiencing a surge with between 1 and 2 months of inventory. So again, when people ask her, how's the market? Her answer is, it depends. I think that's spot on. And the interesting thing is, when people always say, what's the most important aspect of real estate? And people say location, location, location. Those areas I just mentioned are great locations. So again, not to say things aren't flying off the shelf, but we kind of saw it real time firsthand, where we had a property in Sloan's Lake that sat for 90 days at a more expensive price point. We saw where the market was going. We listed our West Wash Park house. We went under contract in the first weekend. But if you'll remember back a few episodes ago, I actually lost money out of the gate, and that was super painful. But I priced it just to move it so I could get that money back and do different deals. So love her synopsis and her summary. And as we transition and wrap up today's episode, kind of want to talk to you guys about like, okay, great, you've got data, but what do you do with that data? So what we're doing right now as we end fourth quarter, and then what we really look at in 2025 is, for us, it's really getting back to basics. And the good news is, even looking back at Megan's data from a week ago, it's starting to trend in the right direction, in that days on market are coming down a little bit. Active listings are coming down. We were, again, at 11,100 roughly. We're now at just over 10,500. So slowly, they call it an absorption rate, which means there's less stuff coming on the market, and then stuff that is on the market is getting scooped up. So we're getting slowly back to potentially a seller's market, leading into that peak selling season, which is, again, in our experience and opinion, February through May. So really kind of looking at that active inventory, days on market, where are we focusing? Again, we're getting back to basics. We are kind of keeping to our sweet spot, which is between $400,000 and $800,000 for purchase price and sales price. Again, would I love to buy something in the threes? Yes, but it's Denver, so we don't really get that opportunity too terribly much. And we're kind of following our own advice. So I'm excited to give you guys some deal analysis updates here in the next couple of months. But we purchased a property in Inglewood. I'm super excited. It's literally 0.2 miles from the Broadway Collective, our office building. So actually, it's beautiful weather. I'll walk there instead of drive to check on the project. So we bought that one for $471,200. It's kind of our classic 90-day rehab. Our ARV is $775,000. How much we sell for that thing on the back end? $775,000. If you'll remember, our number one metric is called dollars per day. And that's how much net profit are we making divided by the number of days we hold it. And so with this one, we are holding it. We'll be done probably in early December. So we're going to hold it for a full month. We never like to list over the holidays. So we factored that in. And even with that, we're actually still doing a $469 net profit per day. Even with that extra month, it's going to be about a $60K net profit and 9% ROI. So that's what we're doing, buying it and going in. Definitely check the show notes, because we're actually doing some fix and flip live meetups at the specific flip. So we'll kind of show you guys live exactly what we're doing. And then we've got another project in Arvada, again, kind of staying away from central Denver, staying away from the large permitted projects in central Denver. And we're doing one in Arvada. It's kind of crazy. I'm looking at my notes, and they're only $1,000 difference in purchase price. So we're buying this one for $470,250, and it's a 75-day rehab. And the ARV is a little bit lower. We want to be conservative on this one because the layout is not funky, but it's not just your classic layout. And so that one starts here in the next couple of weeks. We've got that one penciled for a $548 per day profit, $68K in net, and about an 11% ROI. And the difference between that one is that it's in better shape. The one in Inglewood it really needs kind of everything. A lot of major systems as well. The one in Arvada is going to be a quicker flip. And it's kind of interesting. I've never had to experience this before, so we're always learning. We work with this amazing family. Dad had moved into assisted living a handful of months earlier, and adult kids were selling the property. And sadly, Dad passed away 3 days before we closed. And so that put the property into probate. So now the executor is handling all the affairs, and they're getting everything done based on this gentleman's, will, I believe. And so I don't have a lot of experience in that. So we're really trying to learn that system. So if there's any estate or probate attorneys out there listening, please call me. We definitely need and more, want more connections to help these families, but we'll probably be buying that here in the next week or two. And it's definitely something that we're excited about. Again, we're getting back to our bread and butter, which was honestly 2018 to 2019. Our average close to close was 97 days. So buying it, fixing it up, listing it, and closing on the back end, that 3 to 4 month time frame, trying to get about $500 per day for net profit. And again, trying to stay away from these large permitted projects. So not to say we won't do stuff in Denver, but it's just not worth it, in my opinion, for the risk reward of higher purchase price and longer return guidelines. It's just not worth it. The other cool thing is that we'll probably have a separate episode that we'll fill you guys in on. And we are running the Arvada project with a high net worth individual. And so what we're doing is we're running this on their behalf. We're going to charge, we essentially charged an acquisition fee to find the deal because it was an off-market property. Instead of a commission, it's off-market. So it's kind of acquisition fee instead of commission. Then we have a project management fee and a general contractor fee that we're going to earn because we're running everything for this husband and wife team. And then we actually sell it at a discount on the commission side because they're such great clients and we're doing volume with them. They are phenomenal people. They're ultra high net worth individuals. I think right now that we're filming this, I think they're in Turkey. So they are literally traveling the world. We're running the project. They can check in as much as they want online with the way that we run things on monday.com and Google Drive. And we're going to rinse and repeat. So again, it's all about the velocity of money so that we can do more. So as we wrap up today's episode, we really want to key in on looking at specific data that's going to help you make very informed decisions. We're following our own rules of getting out of more expensive flips and doing more of our bread and butter flips, and then using that data to make your final decision. It's definitely something that you need to take into account, but at the end of the day, you should use your gut opinion to make that final decision. As you think about what you want to do and how we can help you, we've got a lot of meetups going on. So check out the show notes. We've got Fix and Flip Live events going on. We have investor happy hours going on. I would love to hear what data you're looking at. So please connect with us directly. Thank you so much for listening, and we'll catch you guys on the flip side. Thanks for tuning in to this week's episode of Raising the Flipping Bar. If you found value in our insights and stories, let's keep the conversation going. Connect with me on social media and be sure to share this episode with friends or colleagues who might benefit. Your feedback and reviews help us grow and reach more listeners like you. So please, if you enjoyed this episode, leave us a review. Thanks again to the Elevation Academy for sponsoring today's show. If you're interested in learning more, click the link in the show notes below. And remember, every property tells a story, every deal brings a lesson. Keep reaching for those goals, and we'll catch you on the flip side. Hey everybody, thank you so much for listening and watching Raising a Flipping Bar. Just a basic overall disclaimer is that A, this is not legal advice. B, this is not tax advice. C, this is not financial advice. I hope you get the gist, but I'm obviously not a lawyer, not a CPA. Hell, I'm not even a real estate agent, actually. But in general, we hope you get a ton of value out of this, but there is a bit of a disclaimer. Please consult a professional if you have any questions whatsoever. Thanks.